This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Robert Crea of K&L Gates. Robert, thank you for joining us.
It's great to be here. Thank you, Hall.
So, can you tell us a little bit about your background and what you did leading up to the role you're in today?
Sure. Well, I am an investment management and corporate transactional attorney at K&L Gates. And in 2016, one of my clients approached me and asked me, have I ever heard of something called the Dow? And could I create a similar investment vehicle in compliance with U.S. securities laws that actually does what the Dow did? And I had never heard about the Dow, although right around at the time that this question was posed to me, there was a lot of noise about the Dow's $150 million freeze up. But looking into the Dow was a wonderful project and a wonderful introduction to the world of cryptocurrencies and tokenization of traditional assets such as limited partnership interests. And that research caused me to realize that the digital tokens that were issued in the Dow were probably securities, and that to actually structure a vehicle such as the Dow might be possible, but that there would definitely need to be a lot of regulatory hurdles to pass.
So today, blockchain is one of the hottest topics out there, and there's so much money going into new startups around the blockchain. And we had this thing called initial coin offerings. It was super hot last year in 2017. And then the SEC came in and said, well, these are really securities, they're not utilities. And we had a lot of heart searching and soul searching, trying to figure out, well, how do we manage this fundraising process called initial coin offerings for blockchain applications? Are they tokens that anybody can use, or are they securities where they're under the SEC laws? And so as people move forward with funding blockchain applications, they're still wrestling with this thing that the SEC says is, well, they're really all securities, so just treat everything like a Reg D or Reg CF or one of the standard fundraisers out there. As we go forward with it here in 2018, how do you see the industry evolving?
Well, you're correct, Hall. In 2017, I'd say very much the theme around many ICOs was, at least within the context of U.S. securities laws, was that a token issued in an ICO was to have some sort of utility. And the argument being that if a token has utility, then it could not be actually deemed a security. And there were various structures around many of these ICOs to actually preserve the utility nature of the token. The most prominent of one was called the SAFT, a simple agreement for a future token. And the SAFT as an instrument was designed to be a security, but that after the SAFT was signed, there was going to be a period of time during which the platform that was being funded by the SAFT would be developed. And then after that platform was developed, the token would be issued, and the token would have a certain amount of utility on this platform. And once issued, the token itself would not be a security. That was a novel theory and one that was very risky. And ultimately, because of organizations such as the Cardozo Blockchain Initiative, which was sharply critical of the SAFT, and then also the release of the SEC's report on the Dow in July 2017, and its subsequent cease and desist order in December 2017 against Munchie, which was very much structured as a utility token and also sold with a pre-sale instrument similar to the SAFT, it became very clear that the SAFT approach was uncertain. In February of this year, SEC Chairman Clayton said that every ICO that he has seen is a security. And so now in 2018, we're in a very different world than we were last year. The world being now that everyone wants to actually issue a securities token. But for many issuers or many sponsors of an ICO platform, it often doesn't make sense to actually have a security token for their businesses, especially if they want to have a token that is actually going to be redeemable for some sort of service or product on their platform.
So where do you see it going at this point? I see the same thing, entrepreneurs that really want a utility token because that's what really powers their application and really don't want to go through the SEC and all that goes with that. So what's the next step here?
Well, I think as an initial threshold, I think sponsors need to ask themselves, do I really need blockchain to do what I want to do? I see a lot of prospective ICO clients that come to me every day, and they have novel theories, and some of them sound very interesting, and they want to use blockchain technology. But I ask the first initial threshold question I ask myself is blockchain really necessary for the product or service they have in mind? And sometimes it's not. And I think that there's largely a perception in the marketplace that ICOs are an easy way to raise money. It's a way of raising money without having the traditional liquidation preferences that are associated with raising money through venture capital. And there's often minimal IR headaches, is the perception with ICO fundraising, because so often ICOs have pseudonymous owners. You might know the public address, but you don't know who the actual human being is. And so there's actually relatively limited IR implications. So there's a lot of just initial threshold questions as to whether or not an ICO is the right framework. My advice to most sponsors of ICOs is if they're looking for fundraising to create a business in the current regulatory market, they probably would be prudent to raise money with traditional convertible equity or convertible debt, just traditional angel financing, because there are a lot of wrinkles and difficulties with respect to ICOs.
So what are some of the options people should consider for issuing, say, security tokens?
Well, under US securities law right now, there are basically three paths. There is what is called regulation crowdfunding, regulation A+, and then what is called Rule 506C of Regulation D. And none of those options are all that ideal. They each present separate challenges to prospective sponsors of an ICO. Regulation crowdfunding limits you to an annual fundraising of only 1.07 million a year. There's also certain disclosure obligations that are imposed upon the sponsor. And also a main challenge of regulation crowdfunding is if you issue a token under regulation crowdfunding, you're not preempted from any of the application of state securities laws, which is a major headache and can actually be relatively costly because one has to comply with the blue sky laws applicable to each state in which there is a resident to whom you have sold your ICO token. Regulation A+, there's a lot of noise about, especially in the last 6 months. And Regulation A+, the sponsor can raise up to $50 million a year annually. But the challenge is that you have to have an offering circular approved by the SEC before you actually issue your A+ token. And also you have to get GAAP audited financial statements before you do your issuance, which for many startups often is too expensive for them to do and often just doesn't make sense from a business standpoint, given that one's business is a startup and a newly formed business. So most people are looking towards Rule 506C of Regulation D, which is also called general solicitation. And the advantage of Rule 506C is that there is no offering size limit. Crowdfunding has the 1.07 million, A+ has the 50 million. There is no capital raising limit under 506C. You're limited to only selling to accredited investors, however. You also have the benefit of not needing audited financial statements in contrast to Regulation A+. You also have the benefit of preempting state blue sky laws. But the great hurdle for 506C is that any security you sell under 506C is going to be subject to transfer restrictions, meaning that you can't actually sell it to another person except in limited circumstances. And one of the common denominators for any ICO sponsor that I have met is the desire for those tokens to be traded dynamically on a secondary market basis. And so there's a great unanswered question about how securities that are sold as tokens under 506C are actually going to trade. And if anyone spends any significant amount of time in this space, one will start hearing that there are different theories on how these tokens are going to trade. And one of the theories is that, well, after they come to rest for a year, then it will become freely tradable, relying on this safe harbor called Rule 144. But I think it is prudent to ask how viable that path is, because Rule 144 as a safe harbor has never been used in the context of creating a dynamic secondary marketplace of securities. And so if one should hesitate to think that any token issued under 506C is going to trade dynamically, akin to how ICO tokens or cryptocurrencies are trading generally on many of the existing cryptocurrency exchanges.
Do you think it's going to be possible to ever sell a token that is not a security?
I do. At present, it is not possible because there is not yet a single national registered exchange or alternative trading system that is compliant with FINRA rules and has been approved by the SEC. There are a number of organizations that are seeking to get what is called alternative trading system approval, but at present, none yet exists. And so any ICO sponsor that is planning on doing one of these paths forward needs to be very clear in its disclosure documentation on some of these challenges about if, how, and when the tokens that they are going to sell could actually ever be tradable on a secondary market. We will get there eventually, but we're not there yet.
Even if the SEC had not come in and declared all tokens to be securities and really put the brakes on the ICO mania that was 2017, the number of ICOs that went down shortly after 2017 certainly would have. I think last I heard, over 40% of ICOs launched in 2017 were dead by the end of Q1 of 2018. And that, of course, gives investors pause when you see that much failure rate coming in so fast that, well, this is harder than we think it is. And then people start to look for, well, how do I find quality ICOs out there? And so what's your take on that?
Well, quality control, I think, is very important to investors, but it's also very important to any responsible law firm in onboarding a client. K&L Gates, we're very careful about screening who we bring on as clients because there is a lot of uncertainty in this space, and there are also a lot of bad actors. And so one needs to be careful about that. So we tend to apply a variety of screens. I think the initial first threshold question is, as I mentioned before, is blockchain really necessary for the product or service that's being offered? In many cases, what we find out is that blockchain really isn't necessary. And if blockchain isn't necessary, is really an ICO the appropriate funding pathway forward? The second question is, given that we are in this environment where the chairman of the SEC has said that every ICO that he has seen is a security, well, most people are talking about securities offerings. So the next question is does a 506c issued token really make sense? And if one has a platform in which a token is supposed to be redeemable for a service or product, by and large, a token will not make sense because every offer and sale of a token has to be either registered with the SEC or exempt from registration. So one has to find an exemption for every secondary market transaction in a token, which can be very cumbersome if one actually intends for the token to be redeemable for a service or product. Another screening question that we apply is, do the founders have technological experience in blockchain? There are a lot of fly-by-night operations out there, and there are a lot of people who have, again, these perceptions that money is easy to come by through a general solicitation in an ICO context. Those are typically not the clients that we want to have anything to do with. And I think a crystal clear screening is, for any prospective ICO sponsor, is, does the sponsor have a clear view on how the tokens will be treated from an accounting perspective? Because this can have significant implications for the taxability of the proceeds that come from that token sale. For example, if a ICO sponsor issues tokens, raises money, and then treats it as revenue, well, it has by and large generated a taxable event that will be very tax inefficient. And most accountants would dissuade any sponsor from actually doing that. So what we really want to see is a ICO sponsor that has already onboarded an accountant and has a very clear idea as to what that token is going to represent on that sponsor's balance sheet.
So those who come to me today that want to set up an ICO, I see some people setting up in the US, some people setting up in the Cayman Islands, there's Malta, there's just other places overseas where they could set up. And I think some people have the notion that that's going to get them out of the US SEC regulatory system. But so based on where we are today, what is the best way to set up an ICO?
Well, with respect to overseas offerings, I think that they can make sense, but one should only structure an overseas offering if one's goal is the tax efficiency for its various investors. I hear often that many US persons who want to do an ICO claim that the regulatory environment in the United States is too onerous for them to comply with. And so they seek to do an offer offering in an effort to circumvent the application of US securities laws. And I had take a very dim approach to such structures. First, I think it's very odd for a US based person to structure an offering overseas. Second, I disagree with the viewpoint that the US regulatory environment is too onerous. What I would say is that we have the benefit in the United States of having one of the most sophisticated securities law infrastructures in the world. And that if any business really seeks to raise money in a responsible way, in a way that assures some degree of investor protection, that complying with US regulatory approaches with respect to securities of paramount importance. Additional challenges that I see with folks who are structuring their ICOs overseas is that, well, one is really expensive because in the end, you have to hire both overseas counsel and US counsel anyway, because even if you're structuring an overseas offering, you still have to comply with what is called Regulation S within the United States. And Regulation S is a framework for understanding how whether or not a overseas offering is truly an overseas offering. And basically to ensure that your overseas offering doesn't actually bleed back into being subject to US securities laws, you have to ensure that there is a quote unquote distribution compliance period, meaning that for a certain period of time, you have to control for the possibility that a US person might actually purchase some of these overseas tokens. In the context of ICOs, that distribution compliance is typically a year. And so one basically has to actually create either through the technology of the smart contract pursuant to which the token is issued or some other framework to ensure that the tokens that you sell overseas don't bleed back to any person resident in the US, because as soon as you have one sale that does so, then by and large, your offering is no longer an overseas offering. It's an offering that is subject to US securities laws. Well, another hurdle for a US person who's doing an overseas offering is that even if one is successful in complying with Regulation S, as a person who's resident in the US, one is still possibly subject to criminal and civil sanctions regarding fraud and misrepresentation in the sale of those securities.
Right. So, given where we are today, what do you anticipate will happen in the months and years to come in this area? What's going to happen next?
Well, I think we are in a very early stage with respect to ICOs, an early but exciting stage. And already we're seeing within Delaware, for example, there is an increasing amount of efforts to update Delaware corporate law to contemplate the possibility of blockchain-based securities. And I think we're also going to see in the next year or two the development of an alternative trading system and possibly a national securities exchange for hosting the trading in tokens. And eventually, I would not be surprised if we see more traditional corporations hosting their securities on blockchains and using those as cap tables. So I think that over time, we will have a blockchain-based ecosystem that's going to host trading in securities that is going to be compliant with US securities laws. But this is an evolutionary path. It's going to be evolutionary steps forward as opposed to a revolution that happens overnight. And I think a lot of folks are seeking that revolution by looking to overseas jurisdictions which have laws with respect to securities that are not as developed as the United States.
Well, it certainly will be a great evolution to see come into place. In the last few minutes that we have today, what else should we cover?
Well, I think that one thing that is going to be very interesting for ICO sponsors, investors to focus on are the cryptocurrency exchanges themselves. I think that there's a number of interesting exchanges out there, but the regulatory environment for how these exchanges are supposed to operate is very uncertain. And I think that as soon as we get additional guidance from the SEC or the CFTC as to what agency has jurisdiction over these exchanges, then I think we will see a sea change in the expansiveness of blockchain technology with respect to securities laws. As soon as one of these exchanges, as we get guidance as to how these exchanges will operate in compliance with either the SEC or the CFTC, and we get additional comfort that customers on these exchanges are being treated fairly in a way that is in compliant with US law, then I think we'll see not just a great evolution in terms of capital raising opportunities for startups, but I think there's also the possibility that we'll see additional retail investor products in this space, particularly, say, ETFs or mutual funds. So there's a lot of opportunities. There's a lot to be excited for in this space. But I do think that there's going to need to be a certain amount of patience as regulators and the blockchain industry evolve together.
Yeah, many people compare this time to that of the dot-com days when there was plenty of irrational exuberance there as well. But the one thing that seems to be different is the SEC is taking a much more proactive role this round than they did on the last round. Of course, the last one did not end well. This one probably will have a softer landing given they're coming in, putting the brakes on things a lot faster, and it'd be interesting to see how it plays out. Appreciate your giving that word to us today about it. How best for the listeners to get back in touch with you?
Sure. Well, feel free to reach out to me at robert.crea, C-R-E-A, at klgates.com. I'm also resident in the San Francisco office of K&L Gates and can be found through a quick and easy Google search.
Well, great. Well, appreciate that. Hope to have you back for a follow-on interview and want to thank you for your time.
Thank you, Hall.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.